with the latest on the corporate front, all the market trends, expert opinion, and sound business advice. It is your unique window into the business world, direct from the heart of China.
Hello and welcome to Biz Today. I'm Zhao Yang in Beijing. Coming up, we will have half an hour of business news and analysis. On today's show, OPEC Plus has agreed to extend oil production cuts well into the year 2025. And congestion at Singapore port has escalated, leading to significant shipping delays and price surges. So what does all this mean for the global economy? And now let's begin with our discussion. OPEC Plus, a grouping of the world's major oil producers, has agreed to extend over 60% of its oil output cuts well into the year 2025. The move aims to bolster the market among weak demand growth, high interest rates, and rising U.S. production. The grouping is cutting output by over 5.8 million barrels per day, or about 5.7% of the global demand. So why has OPEC Plus decided to extend their oil production cuts, and what does it mean for oil prices and the global economy? For more on this, join us on the line now are Professor Qu Qiang, Fellow of Belt and Road Research Center at Minzu University of China, and also Yan Liang, Professor of Economics, Willamette University. So I will start with you. So why does OPEC Plus members want to extend the oil production cuts well into the next year?
Right. So the major reason is that the OPEC Plus countries, they wanted to shore up the demand. And that is because there is also right now the very slow sort of demand growth, and also with the high interest rates that are around the country, around the world, and also the rising increase in the U.S.'s production of oil. All of these put a damp on the oil price. So when you look at the Brent crude oil price that has been trading around $80, $83 per barrel in recent days and months, and that's below what many of the OPEC Plus countries needed in order to balance their budgets. So they have been doing this kind of cuts of production since late 2022. Again, this idea that when the market demand is weak, you wanted to contain the supply side, so be able to purchase the price. So right now, as you mentioned, the cut is about 5.86 million barrels per day. And so that's going to be about 5.7% of the global demand. But I think they're also talking about monitoring the global demand. And at some point, they would also start to phase out some of the cuts. So they have two different portions, 3.66 million barrels per day. That is the mandatory cuts by all countries shared together, but there are also another cuts of 2.2 million barrels per day that is voluntarily cut by 8 member countries. So they will start to phase out that 2.2 million barrel per day cuts starting from later this year all the way to late next year. So that way, some countries would be able to increase their production. But again, they will still need to monitor the global demand and also the price to decide if that phase-out cuts are going to be on schedule.
The global demand. So actually, Professor Qu, why have the oil prices fallen by about 10% since hitting a 5-month high in early April?
Well, I think the reason for the price down in oil prices is very obvious. So we'll just take a look at the general situation in the microeconomy. You will find out in America, which is a very important economy in the whole world, consuming oils has been seeing a bad sign in the PMI, not only for the manufacturing, but also in the service sectors. Because in America, a non-manufacturing PMI used to be a very important indicator for, developed economy, not only for America, but also for, many of the developed economy as a whole. So when this indicator goes down, they're basically saying we have a potential recession happening right now in America. And also take a look at the job market. Job market in America are also not within our expectation. It's been slowing down. And also the numbers from the credit card spending, second-hand cards of sales, and also the numbers, the home sellings in America are all, going, not very well. It's been slowing down. So I think we've been hitting a pivoting point, and the, crude oil market has been reflecting to that because this is a fundamental product supporting, every, factors of our economy. So when people's expectation for the big economies like in America are slowing down, so I think the price for the oil, will surely be, going down or accordingly. As well as we've been seeing, there also are signs of the slowing down in the European market as well as in the Asian market. So I think the expectation in the second half of the year is the main reason for, the non-performing oil prices for the OPEC countries.
So yeah, among the OPEC Plus members, Saudi Arabia has actually shouldered most of the cuts. So to what extent is the oil price related to, Saudi Arabia's domestic agenda, do you think?
Right. So I think, first of all, I agree with Professor Chu. I think, the slowdown in global demand has a lot to do with, the weaker economic growth in the U.S. as they just adjusted downward their first quarter growth from the previous 1.6% to now 1.3%. Also on the supply side, as you mentioned, that Saudi Arabia was the one that showed the most of the cuts. They right now is producing about 9 million barrel per day, away from their average in the past is 12 million. So there is a pretty big reduction. On the other hand, when you look at the U.S., they have been now producing 12.9 million barrel per day. So it is now the largest country that produces oil, and that has been going on for 6 years now. So you have the weak demand on one hand, and then you have the U.S. ramping up supply on the other hand. So I think that really created the downward pressure on the oil price. Now, when it comes to Saudi, I think this is really part of the grander sort of strategy of pivoting away and diversifying the economy from the oil sector. So when you look at the share of the private non-oil sector in the total nominal GDP, that has increased quite significantly from 42.8% in 2018 to now 44.6% in 2023. So again, this is the strategy trying to diversify the economy and rely less on oil production, amid the global sort of green transition. They have been, setting laws to promote, other kind of private sector investments outside the oil sector. They have also been, investing a lot by the Saudi investment funds to deploy capital to stimulate, private sector non-oil investments. So all of these, I think, suggest that, Saudi is willing to take a cut on the one hand to really support the oil price, but on the other hand, try to diversify the economy away from the oil-dependent structure.
So, Professor Chu, so OPEC Plus decision actually coincides with Saudi Arabia selling some, more shares in its oil company Aramco. So, how do you view that?
Well, I think this is a very important move. Saudi Arabia is no doubt one of the leading forces in OPEC, and their decision-making is very important signs for, the collective move in this, the cartel. I think the reason why for selling the Aramco, stock is very obviously, as they just declared, they want to diversify their, economic structures, and they're actually been doing so for quite some time now. Saudi Arabia has been cooperating with America, cooperating with China, cooperating with many economies right now. And those countries are not, oil drillers, oil sellers. They're more like, high-tech companies, manufacturing, strong powers. So Saudi Arabia have a very ambitious plan that is to make their country, into a very, tech-savvy, advanced, manufacturing industry in the future. With tourism, with service and hospitality industries go along with that. So basically, they're looking at the model of China's development and looking at the model of Singapore's development. So they want shake off their reliance on the crude oil alone, and to be more diversified in the future. Because I think they understand in the future that the whole world consumption demand on the oil has been shrinking. Just take a look at the popularization of the EV and also the solar panels right now. I think it stands for the trend of the future.
And yeah, so the UAE's production quota increased by 300,000 barrels per day. So why is that?
Right. So on the one hand, I think the reason was because the UAE has been arguing that they need a higher production quota. They argue that their capacity has been long underestimated. So they're asking for increase the oil production quota. By factoring this, it actually makes the quota system more transparent and actually more realistic.
And Professor Xu, actually, what do you think is the outlook for the global oil demand in the future? As you mentioned just now, a lot of countries are now developing, the green and renewable energy. So to what extent can this green and renewable energy replace the oil and gas?
Well, I think the replacement is a future trend for sure. No one can deny and no one can stop it because solar and wind and the tide powers are free. And I think it will lead to human being towards a better future, enable us with more opportunities towards more diversified economic future. But I don't think we will immediately stop using the fossil fuel and crude oil, and not only for the energy purposes, but also for the plastic, for the polymers, or for some other important chemical resources for the modern industry, oil industry, or gas industry are still very, very important. So I think it's a long-term evolving trend. I think the learning curve will be very, very long. And the whole progress will be zigzagging ahead, not like just a shooting, ahead like a skyrocket. So that is my judgment. But I think in the future 3 or 5 years, oil prices cannot have a very strong momentum. Well, it's more like back in 2008, after the subprime crisis. I still remember it very freshly. Everybody in 2006, 2007 says, well, oil prices will be just more and more expensive as the economy goes bigger and bigger. And oil prices, highest go went to like $148 per barrel. But immediately after 1 year of the crisis, I think the lowest price for the oil per barrel is, 43 or 46 US dollar per barrel. It dropped like more than $100. And that kind of a height, will never be met again, even during the inflation period of time in the past 1 or 2 years. So I think people of the whole world are trying to reduce their reliance on crude oil, and the green campaign and emission-free, movement are, already been enshrined in everybody's mind. And when this concept has already been made in everybody's head, so the trend is going to be irreversible. So in simple, that is, the oil prices or gas prices in the future 3 or 5 years will stay, not very strong, rather around like $40 to $60. I think that's the corridor of the price. And in a very, very long term, the oil price will still be in some places, not diminishing very, very soon. But the whole purpose for the oil use will be switched to some other industrial sectors.
So, Yan, do you agree with Professor Xu?
Right. I agree that the trend is to embark on this green transition. But I think the two thorny questions, one is at what speed? And of course, we're not, we're in this really emergent kind of pressing time with climate change and the impacts. And so I don't think we can afford the luxury of a slow transition. And that gets to the second question, which is, I think China plays a vital role in bringing down the alternative energy costs. When you look at solar panels, for example, the prices dropped by 80% in the past few years, largely thanks to China's manufacturing cost and so on. But we're now seeing the rising protectionism policies in the Western world. And according to the Special Climate Convoy, if the world is trying to avoid sort of the Chinese green tag, this is going to add $6 trillion to the energy cost. So I think it's really the technology is there and the cost is clear that it's much better, when it comes to marginal cost of using green technology, green energy is much lower than the traditional fossil fuel. But we have the geopolitical tensions and the conflicts. We also have a place where, some of the countries simply cannot afford to make the energy transition unless they are compensated for or unless they're provided certain support. So I think those are the really the problems that we need to make the energy transition faster. And we also need all countries to be on board, especially the Western powers that are still seeing this as a great power rivalry when the matter of fact is that, we have this common global challenge, the climate change. But I agree with Professor Chu that the trend is declining oil prices, largely not only because the world's demand has been transitioned away from the oil production, but also because, the United States, as one of the major oil production countries, is likely they're going to ramp up production so we can have more supply than demand down the road.
Well, we're speaking with Yan Liang, Professor of Economics, Willamette University, and Professor Qu Qiang, Fellow of Belt and Road Research Center at Minzu University of China. And after a short break, we'll take a look at congestion at Singapore port. Stay with us. You're listening to Biz Today. I'm Zhao Yang in Beijing. Congestion at Singapore port has escalated, leading to significant shipping delays and price surges. Starting from the second half of May, the number of containers waiting to dock peaked at 480,000. Currently, container vessels are experiencing extended waiting times of up to 7 days for unloading, compared to the Euro half-a-day time frame. The Maritime and Port Authority of Singapore has increased staffing and container handling capacity to address the situation. So first of all, Yan, what is the main reason for the congestion at the Port of Singapore right now?
Right. So this is very interesting. I think, first of all, to contextualize this incident, I think it's important to know that Singapore's port is the second largest, busiest port in the world after the Shanghai port. It handles about 39 million 20-foot equivalent units, TEUs, last year. And it's also the largest transshipment hub. It has the link with more than 600 ports worldwide. So this is quite significant when it comes to the congestion that you just mentioned. The Port Authority cited the reason for this congestion was mostly due to some of the unscheduled arrivals of ships. And we know that the deeper reason is because right now, because of the global situation, so we have the Houthis attacking in the Red Sea, we have the Panama Canal that was with limited capacity because of the low water. We have about 7% of the global container capacity is presently caught in this kind of port congestion, which is 3 times more than the normal time congestion. So I think this is not unique just to Singapore port. And it's also very interesting that, some of the small or some of the disruptions in one side of the world can definitely disrupt, the entire global shipment network. And also the Northeastern Asia now, the congestion rate is about 23%, which is one of the worst. And the Southeast Asia is the worst. It's about 26% of the total congestion of the global container shipments. So again, a lot of these have to do with the fact that many ships have to reroute from the Red Sea or from Panama Canal. And the fact that, just a lot of these unscheduled arrivals, the share of the container ships that arrive on time has gone down to 52% in April, which is about 12 percentage points lower than last year's average. Now, even though this has been improved very significantly from the worst, pandemic years, but still, I think what we're seeing now is, the global shipping industry is still very riddled with all these problems of congestions due to geopolitical regional conflicts, but also due to some of the natural sort of climate change incidents.
And yeah, so what can the Port Authority do actually to address this situation?
Right. They have been, I would say, trying their best. As we know, the Singaporeans are quite efficient. They have reactivated some of the deactivated ports. They have opened up, I think, 3 more the ports or the sub-segments of the ports. And so I think they're trying to really find ways to decongest. But I think it's very interesting that, it's not just Singapore. I just saw the report from the South China Morning Post and talking about, in Shanghai port, they're also facing a very busy season. And with that, they also see, rise in shipping cost. One reason has to do with, again, these, Houthis have been threatening that they are going to expand their attacks into the Indian Ocean. And so that, again, sparked some more fears about these kinds of congestions of international shipments. And on the other hand, with the threat of increasing tariffs in the United States and also potentially Europe, we're also seeing some of the front loading of the shipments, both to try to, avoid the tariffs, cost, but also, to just a front load to meet with the holiday season needs. So it's likely to see, this kind of congestions are going to unfortunately escalate, and that could also add to the cost of international shipping.
And Professor Chu, so if that situation continues, will it cause a supply chain crisis, or what does it mean for the global manufacturers going forward?
Well, I think that probably we're going to see another supply chain crisis happening again. The reason why I think Professor Yan Lang just mentioned, the Red Sea crisis is probably the root cause right now for this delaying and also congesting in not only the Singapore port, and we've been seeing the spillover effect are coming to the upstream and downstream ports, because a lot of the ships and the owners of the ships are seeing, okay, Singapore, they don't have enough berths, and this is probably not a good idea to, load and unload this freights in Singapore. So why we don't just move to Klang and Malaysia, or move to the Shanghai port or the Hainan port, or move to some other port and switch our freight into the on land shipping. And everybody are thinking this way, and then the congestion will happen in some other port as well. And also you have to understand that, ocean shipment is still the cheapest way for the international trade. And every 10 units of the distance, of the cost on sea is basically the same of the 1 unit distance shipment on the land. So we're going to see all the prices will keep on going up, or at least not going down in the foreseeable future. And that will worsen the inflation situation faced by the international market right now. And if inflation can be further stubborn, and then I think the interest rate wouldn't go down very quickly as we expected. So that is going to be a multi-factored, supply chain crisis, not only happening in the transportation sector, but also in the price sectors, in the suppliers sectors, as well as in the market or retailing and wholesale sectors. So it's going to be very compounded and very complicated to solve. And meanwhile, we're going to see some other uncertainties happening because the Israel and Palestine problem, as well as the whole turmoil in the Middle East, are not stopping right now. So we don't see there is a fast slowing down in the Red Sea crisis. As we just mentioned, half a year ago, I very clearly said Red Sea crisis ever since the first attack of the Houthi, our military forces. I said this is not going to end after 6 months, and it's happening right now. So this crisis, according to my new evaluation, is still going to continue for at least another 4 months or 5 months to the end of the year, to the New Year's, shopping season, as well as we're going to see in the second half of the year. In America, the dock workers in the port will also go on a strike because they're trying to seal the deal for the coming years, the salary raise. So this is going to also pose another threat, as well as, Ukraine crisis is still are here. So I think the supply crisis or supply issue will still be with us for quite some time, and Singapore is just one choking point of it.
So, Yan, how significant do you think is the ocean transportation for today's logistics? And what does it mean for the global manufacturers going forward? Do they have any alternative ways?
Right. I think this is a very interesting question. I think, there has been the argument, that now we're facing this deglobalization trend, that a lot of times production is going to be more localized and regionalized. So I think, the more we're seeing this kinds of international shipment disruptions and also cost increases, we're more likely to see the kind of disruptions in the global supply chain. And that definitely is not going to be conducive as far as, efficiency is concerned. So I think, again, going back to the story, now we're seeing, for example, in Shanghai, the shipping costs that go into Europe has just jumped up by 12.6% last week. And that on top of, all these threats of, tariffs, we're likely to see, the global supply chain to be further disrupted. And like Professor Chi mentioned, this is definitely not going to be helpful for inflation and also not for monetary policy easing. So all of these could hurt the global economy. And I think, the more these kinds of geopolitical tensions and also these kind of regional conflicts are going to be, the more we're going to see interruptions in the global supply chain. And then the more we're going to see more sort of localization and regionalization of global supply chain. And that, again, could heighten some of the tensions between countries. So this could be a vicious cycle. So unfortunately, I don't think at this point there's very good alternative to this. So I think the best we could hope for is, for some of the global big powers, right, to really have the wisdom, the courage to really stop the kinds of unnecessary and I think very dangerous kind of heightening of the risks, both at the regional level, but also, between big powers, and really see global economy, peace and security and development as a priority instead of sort of the power rivalry. From what we have seen, during the pandemic and also after the pandemic, is that a lot of this idea of reshoring, friendshoring, disrupting, the global supply chain can only do more harm to each country's economy, but also, to the global stability and prosperity. So I think the sooner countries can realize that, I think the better the global economy is going to be.
Well, we're speaking with Yan Liang, Professor of Economics, Willamette University, and also Professor Qu Qiang, Fellow of Belt and Road Research Center at Minzu University of China. And that's all the time we have for this edition of Biz Today. I'm Zhao Yang in Beijing. Thank you so much for listening.